Welcome to the Quantpedia Awards 2026. In this video, we talk with this year's winners about their research and key insights.
My name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia, and you are all welcome to watch this video. So right now we are having the interview with Quantpedia Awards 2026 winners. I have here with me Michael Robbins, who is the head judge of our committee in Quantpedia Awards. So thank you very much, Michael. Thank you for joining me. And I would like also to thanks to Timo Wiedemann and Heiner Beckmeyer. I hope that I said your names correctly. I'm not very fluent in the German language, but I tried. I mean, my best. Timo and Heiner are our winners, and I'm very happy to have them here. And we will have a discussion about their paper. They have a short presentation for us. And I have a first question, and the first question is very classic. Timo and Heiner, tell us something about yourself. Where are you? What are you doing? Who are you? And how you get into the quant world?
Sure. I mean, I'll just go ahead. Timo and I were both based in Germany, and we used to be postdoctoral researchers at the same university here in Münster when we wrote the paper and, put all of this together. So this is kind of where we're coming from. I've since moved to being a practitioner of sorts, being an independent consultant, and I work with asset management teams and firms, hedge funds and prop shops to actually try to translate some of the academic insights that we can get, such as, the paper that we will present here, into, practice and actually make it work. This is, kind of where I'm coming from.
Yeah, as Heiner said, we both were at the University of Münster, did our PhD there. We had a lot of fun over these days, over these years, implementing some interesting stuff. And the paper we've going to show you now is one part of my and Heiner's dissertation. And to myself, as I said, I did my PhD at the University of Münster in finance. Before I did I was in physics, and now currently, as of this year, I switched to the practitioner's world as well. Currently working as in quantitative equity at a local insurance company here in Münster.
Yeah. So you started as academic, but the academic world, lost you.
Kind of, yeah.
In a way, yes. It has its pros and cons, let's put it that way.
Okay. So that's fine. Show us your paper. What is about, and what's the title?
Sure. Let's see.
Heiner's going to do the first part. I will walk you through the second part. I don't know if I should start the screen sharing afterwards. So if it's going to be cut out, then it might be easier for us as well.
All right. So, I'm very happy to, be able to present our paper, at least to give a broad overview of what we've been doing here. It's titled All Days Are Not Created Equal, Understanding Momentum by Learning to Weight Past Returns. And this is what Timo and I have been working on. We're very proud and honored to be selected for the Quantpedia Awards here. So I think this is fantastic. In general, I think, initiatives like this that are trying to bridge the gap between academic research and practical relevance are very important. This is what I'm doing now as my day-to-day job. So obviously I see, that this is of great importance. So as the title already suggests, we are looking at a momentum trend following type strategy here. And essentially we have a small tweak that we add to it, which allows us not only to come up with a better momentum strategy that doesn't suffer from a lot of the drawbacks that momentum typically suffers from, such as momentum crashes and generally lackluster performance in recent decades, but it also helps us understand helps us shed some light onto, what is actually driving trend following profits in the equity market. So to briefly introduce, what do we mean by the title? Well, it just means that some days might be more informative than others, right? It's not really a transformative statement, and we are definitely not the first to kind of look at this. You can go to market microstructure theory, which already tells us that price innovations themselves are a consequence of new information, right? So from that, it kind of follows that if you have a large price movement, well, maybe that price movement just carries more information than days where you see less price movement in general. And in general, we also know from the previous literature that the standard momentum signal construction might not be the most optimal. right, where you just look at past returns over a fixed look-back window, for example, Novi Marx has shown in 2012 already that there is an interesting effect here in momentum where parts of the look back, the formation period of momentum, are in general more informative about future returns than others, right? So there seems to be some information contained not only in the average return over the look back window, but also in parts of it, right? And the same applies to this very nice paper by Zida and co-authors, which is looking at this frog in the pan hypothesis, and which is essentially showing that it's not just the return that you see that is informative. So what's my past, say, 12 months return, but it's also the shape of this return. So how did it come about? Was it a single day that saw a large jump and the remaining days were essentially zero? Or do we see tiny increments every day, right? And this return profile actually tells us about, differences in returns going forward and whether momentum is actually stronger or less strong. Now, what these previous papers have in common is that they essentially find an effect and impose essentially a form, a function as to how these different information pieces or informative pieces that can be in past returns are supposed to be extracted and aggregated. And this is kind of where we break, right? We propose a very small change to how momentum signals are derived, but it actually significantly improves performance of momentum. And as I said, it allows us to study these underlying mechanisms that actually drive momentum returns. So, conceptual idea in a nutshell, super simple. This is what you typically do in momentum, right? You have this graph right here. These are the look-back days. This is the weight that you place on the returns that realized on the look-back days, right? So in the standard Jagadish and Titman formulation, you essentially just say, okay, let's look at the past 12 months. This is kind of my momentum, formation period. Let's exclude the most recent month because, we typically see short-term reversal in the equity market. And then we just weight these past returns of these 11 remaining months in the formation period equally. So it's just a 1/n treatment. You can see this right here, right? All returns, all 231 daily returns here are treated equally. So in log space, you can just sum them up. And this in turn is then your momentum signal. This is kind of the expected return when you're following a momentum type strategy, and that you would use to then sort your stocks by and, go along the winners, short the losers. This is your signal. What we do is to allow for a simple, flexible weighting function. So instead of saying that it's just fixed in time and across assets, it's just 1/n, where n is the number of days in your look-back period, we say that these weights can not only depend on the time period that we're looking at, so they can change over time, but they also change across assets, because we posit that maybe there is a differential information quality in different returns of the formation period for Apple versus NVIDIA, for example. Now, the name here already suggests that we're going to deduce something about the firm, which is, characteristics about the firm, which lends itself to the name characteristic managed momentum, where these flexible weights will be a function of observable characteristics. Now, of course, there's a long history in asset pricing research of actually using characteristics for some type of conditioning work, right? There's a work that is looking at, probability of defaults, and it's using characteristics of the firm to kind of gauge that. Obviously, there's a large body that is looking at the risk and return trade-off in asset pricing research that is also using characteristics as this tool. And we now say, okay, let's use that vast array of information that we have about a firm to essentially condition this weighting function. So how should we condition these past realized returns for stock I? And we allow this to change with the characteristics of the firm, arguing that these characteristics will tell us about informative differences between different firms. And then this is our signal right here. So instead of having an equal weight of past returns, CMM is simply a weighted average of past returns. Now, a bit of an outlook here. Now it works. Doesn't really come as a big surprise, I guess. Otherwise, we wouldn't be having this conversation, I guess. But actually, this flexible weighting function is very important, right? Sharps more than double in value-weighted returns. Interestingly, the weights are very sparse on average. So some days are much more informative than others. And that also means that we move away, far away on average from this equal weighted assumption. And we find that firm-specific news days are very important. Macroeconomic news days aren't that important. Now, the academic view here, lends itself to us trying to understand, okay, what is the economic driver of it? What is kind of the story that these results are telling, and what can we then draw as inferences about general trend following profits in the equity market? Well, we first find that characteristic managed momentum predominantly extracts a trend from an underreaction to news, right? So we find evidence in favor of a behavioral explanation. We argue that it's not compensation for time-varying risk or risk factors in general. And we argue, or we find information that it is not an overreaction to news, but people tend to underreact to these returns in the look-back period, and this is what is driving future performance. Now, I will talk a bit about the theory and the methodology, and then Timo will, take over and walk you through some of the results, both as it relates to the profitability, but also some of the economic insights that we can draw. So, in a nutshell, now this is a lot on this slide, but in a nutshell, as I've said before, we use observable firm characteristics, right, which we put together here in this vector Z. So Z is just different characteristics of the firm, right? Can be the book-to-market ratio of a firm, can be market equity, can be past turnover, stuff like that. It's all combined in this vector Z, which obviously changes for different assets, and it changes over time as the different stocks are migrating in their characteristic makeup. And we also introduce daily returns that actually realize over the formation period. So this is the second piece of information, right? We use these as firm-specific instruments to allow for variation in the weights that we then place on these past returns. So the weighting function here for the 231 returns in the look-back period is just a generic function here of past returns themselves. So what is kind of the return profile going back to the paper by Da and co-authors? And what are the firm characteristics which inform us about very strong, very strict differences across different assets? Now, of course, because we want to make this as interpretable as possible, right? Even though we have this weighting function here, which is a generic function. In our case, it's a simple, but a neural network, right? So it's highly nonlinear, but we still want to make all of this economically interpretable. And we do that by essentially following standard momentum. Standard momentum says that each return is equally weighted. So the weights sum to 1, we define the same boundary condition, and the weights are all positive, which we also define, right? So the weights that we get from our weighting function here are, just as the equal weights in standard momentum's formulation, just averaging realized returns over the formation period, with the twist being that this averaging isn't equal, right? It's varying over time, it's varying across assets. There's a lot of variation here. And the big question, obviously, then becomes, does this variation in weights going from a linear or an average, a simple average of past returns, to a weighted average of past returns, does that actually help us in uncovering trend following or momentum type signals? So the model, if you're interested in this, have a look at the paper. We're just going over this very briefly. You can, of course, also send Timo or I, an email, and we can talk about that. But in general, what we do is that we feed this vector of firm characteristics here. We have 153 into a feed-forward neural network. So very simple neural network, but still a non-linear function. And we get a single feature out of this. So we condense the big vector of 153 firm characteristics into a single number for each firm. Why do we do that? Well, we wanted to make it as unlikely for the model to just be using information about firm characteristics as opposed to a weighting of past returns. And that is how we can essentially do that while still allowing information about the firm's characteristics to go into the model estimation. So this feature, which is just a number, is then combined with the firm's realized returns. We just take the dot product here. It's essentially a dot product similarity, very similar to what people are doing in this attention literature, which is, feeding large language models today, the big transformers and whatnot. So we kind of borrow from that, but it's a very dumbed down version of it. And that gives us these different scores, which we then feed through a softmax function right here, which is just doing one thing. It's just abiding by the boundary conditions that we see right here. So the weights sum to 1 and the weights are all positive. And that's essentially it. That's the whole thing. That's the whole estimation, such that we can then look at, okay, what is the investment signal for CMM? What is the expected return, so to speak, based on past realized returns? Well, it's just the standard momentum signal here, so the average realized return. And then we have this deviation function, which is just the difference between the weight that our model places on each return and the average, right, which is standard momentum's signal, essentially. So if the model expects that there is a day, say D plus right here, that is more informative than other days, or more informative than what simple momentum would imply, which is it's as informative as any other day, we should place a greater weight on that than the average weight. However, because we have these boundary conditions, so because our weights still sum to 1, that requires us to underweight a different day or several different days to kind of make room for this overweighting of day D plus. So in a way, our setup is kind of, parsimonious in a way and structured in a way that it is forced to triage between which days are expected to be particularly important for the formation of these momentum signals. And the kicker is, if there's no information in the entire setup, if essentially there's nothing here, the prior of the model, the way that the neural network is estimated, is that on average, it'll just collapse the standard momentum. So if there is nothing here, if the model expects there to be no additional information to be drawn from past returns, above and beyond what standard momentum is already capturing, well, then the model will just collapse to standard momentum. Timo will take over and walk you through the model's performance and some of the economic intuition.
I'd like to show you that what Heiner said is not just theoretically appealing, but that it actually works in a backtest. So we haven't tested it yet in real life, but in a backtest, it works. So what you see here is basically the cumulative return to for $1 investment into our CMM strategy. So this is the black line above, which is compared to an investment in the standard momentum strategy, the light blue line below. We also compare it to an investment in the market, which is the black dashed line at the bottom. What you see in this graph basically are 4 things. So the first thing is that CMM, so our strategy, actually ends up above standard momentum. So the average return over the investment period is higher than compared to standard momentum. The second thing you can see is that that CMM is not prone to so-called momentum crashes. As you all might know, the standard momentum strategy is prone to crashes, especially in the aftermath of crisis. So this holds true, and that you can actually see here in the graph, in the aftermath of the financial crisis, as well as during the COVID seller period at the end of the graph. The second thing you see, or the next thing you see, is that the return stream for CMM is rather flat. So you kind of see a flat line, meaning that the volatility of the return series is rather low when compared to standard momentum. So both higher average return and a lower volatility lead to higher Sharpe ratios. You will see on the next slide some numbers, but looking at this graph, you already see that the Sharpe ratio for a CMM strategy should be higher. Another important thing is that it has been shown in the literature, but it's something you also see here in the graph, is actually that momentum ceased to work after 2003. So the cumulative return to the standard momentum strategy is rather flat here, while CMM still tends to outperform. You see a degradation in the return profile on the average return, but still it generates significant positive returns, which you can see thank you, Heiner, on this slide. which basically shows you the portfolio characteristics. You have on the left-hand side the portfolio characteristics for our CMM strategy, as well as before 2003 and after 2003. So what you see, and which was already highlighted in the graph before, is that momentum. Also see in the period after 2003, CMM generates significantly positive returns. Yeah, so this return of 11% is lower, as I said. So there is some degradation in it basically stopped working. Yeah, so there is this 4%, which is not statistically significant. We also see that the volatility for CMM is much lower as compared to standard momentum, which then ends up in a higher Sharpe ratio, which is almost threefold when compared to standard momentum. There is also evidence that is less prone to severe crashes. Of course, it cannot be avoided overall, but when compared to standard momentum, which exhibits a crash of almost 80 or more than 80%, I think this was in the aftermath of the financial crisis. It compares quite well to our CMM strategy, which only loses 27%, or roughly 20. We also compare, compares our CMM strategy and check how it relates actually to standard momentum in an independent double sort. Yeah, so what we do on the top, you see that we sort stocks independently on our CMM signal into quintiles as well as into quintile based on the standard momentum, and then form 25 independent portfolios. What is plotted here is basically the average return for each of these portfolios. So if you look at the last column, you see the performance of our CMM strategy within each standard momentum portfolio. And what you see is that we have significant positive returns for each, or within each, which within each standard momentum quintile. The same does not hold true for standard momentum. So for within each CMM quintile, we do not see any significant return spread generated by the standard momentum strategy. What is also interesting to see in this S table is basically the first row. Yeah, so within the stocks which would be identified by standard momentum as losers, CMM performs especially well. Yeah, so basically what this tells us is that CMM is able to identify those past losers which are expected or which tend to rebound going forward. Yeah. The last thing we looked at, or which we want to show you today, is Heiner has explained to you that the only difference we see comes from a different weighting in past returns. Yeah, so the portfolio formation is essentially the same. The only difference we apply here is a different weighting function. The question we had in mind was, well, is it the case that there are just some days which tend to be very informative, or does CMM only changes the weights by a little? And we call this sparsity in the weights. And what you see here is kind of a cumulative density function. So what we did for each holding period or formation period, we sorted the returns by their weight associated to them. Yeah. So the first one would be the return, which gets the highest weight, and then it's sorted in descending order. Yeah. And what you see here basically is that for the average observation, which is the dark blue line or the dark black line, the return with the highest weights already gets more than 20% of the weight on average. Yeah. If you go one further, then two returns in the formation period already get roughly 30% of the weight. And if you go even further, then you see that we cross the 50% line at roughly 35 return days observation. Yeah. So this is just on average. What's plotted there is also basically the standard deviation or the quintiles or the variation around the mean. And what you see is there is a lot of variation. So it's not the case that we find a one-fits-all solution. It's rather the case that it's very important to look at the different firms independently. Yeah. So there's a lot of variation, and we see that the firm-specific information is very important. Yeah. So we tested in the paper. You can see that we tested just to overrate certain days in a generic fashion, and it doesn't work. So it's important to apply this machine learning function to make this work. we wanted to focus more on the practitioner's view, so I'm going to keep this economic mechanism rather shortly. Yeah, so Heiner said it already, so I'm just going to wrap this up a bit. So what we find, and we show this all in the paper, so it's open access. So if you want to have a look at it, feel free. And if you've got any question, just also feel free to contact us. So the mechanism we find, or the explanation we find, strongly favors an undirection to news explanation. Yeah? So we find that an undirection to news might be the dominant driver of CMM success. We also find that it's kind of related to information discreteness. So the frog in the pan hypothesis Heiner has already talked about. Of course, we also test for alternative explanations, such as behavioral-based explanation or risk-based explanation. One to mention would be the paper by Kelly and co-authors, which basically show that standard momentum can be explained by variation in the compensation for risk. So changes in beta basically over time can explain momentum. We've replicated their findings. We've tested this in our case, and we do not find that CMM can be explained by any of these measures. We also have a robustness test showing that our results hold in international markets as well. So let me quickly conclude. Yeah. So what do we show in the paper? Well, we show basically that changing how past realized returns are weighted to form a momentum signal significantly increases the profits of trend following strategies. Our characteristic managed momentum strategy offers substantially higher Sharpe ratios, significantly reduces drawdowns. Of course, we do see some drawdowns. They cannot be avoided, but they are significantly reduced. And more importantly, it also works in recent decades. What we find as the economic driver is an explanation based on underreaction to news. And the main takeaway we wanted to give you is that momentum strategy actually are alive and well and still can be exploited. So thank you very much.
So I have a first question from the practitioner's point of view. So what is the investment universe? I think it's in the paper, but you have not mentioned it. So it's like, I don't know, top 3,000 or all the stocks, or I mean, what was the investment universe? What were the data that you were testing at?
So in this paper, it's kind of the standard makeup, if I recall correctly, of this Jensen Kelly Peterson data set, which is essentially providing the firm characteristics and replication code for it. So stocks have to be kind of primary issues. They have to trade on the big three exchanges or be primarily listed on the big three exchanges. I'm pretty sure that we also have kind of a floor on the availability of characteristics at each point in time, but that is just to kind of filter out really wonky stuff. Yeah. So, it is a broad universe, probably broader than what many people would utilize in an investment setup, because there is a lot of stuff that is probably not as tradable as the paper prices would suggest. But what we do is that we, follow the standard approach, family fringe and whatnot, and using value weights where the cutoffs are essentially from nice stocks only, right? Which, it's not a perfect remedy in by any means, but it does push, the general weighting towards very large firms.
Value weighting helps a lot. I have another question, regarding the characteristics that are fed into the machine learning model. So if I understand that correctly, for example, if you have like price to book or whatever, is like daily price to book ratio that's fed then. And then, if you have the earnings, it's like earning news with the dates, etc. So, it's like daily based characteristics and there is 153 of them, and some of them are price based, some of them are fundamental based. So like price to sales, price to books, price to cash flow, whatever, etc., etc. And they are daily based.
So your paper presents CMM as an improvement in the way momentum aggregates past daily returns, but the weighting rule is conditioned on a large set of firm characteristics. Can you decompose the strategy's outperformance into gains from changing the return weighting function, gains from the predictive content of the characteristics themselves, and gains from the interactions between the characteristics and the particular past returns?
Fantastic fun. That is something that we have thought about a lot when writing the paper. I remember in the first version of it, when we were kind of composing everything and coming up with ways to actually look at this, we had a much more flexible way to come up with the weighting function, right? Which obviously raises the question, okay, how much of it is just kind of the known structure, right? Where we know that firm characteristics have explanatory power over future returns, and how much is this new weighting approach that we now bring to the table? And what we do is that we, as I said in the presentation, we essentially condense the information from the 153 characteristics into a single number per firm and date. And what that does in this weighting function, right, in the softmax weighting function, is that it's essentially just a way to shift how the weighting function looks. It's just, so the characteristics are just a measure of, how much difference, how much space do we put on between the weights that we place on very large returns realized in the formation period versus very small returns. And you can also flip the sign, right? So do we kind of overweight very large positive returns or underweight or overweight very large negative returns? So it's through that the characteristics don't really have that much wiggle room to kind of influence the predictability exercise. Of course, it's not impossible that this scalar alone, this one digit alone, is still doing a lot of the legwork. What we have done in the paper, and maybe Timo, you can relate to this a bit more, is that we had a look at a restricted model, right? Which is essentially just given access to return information, no firm characteristic information. And as far as I can recall, it's much, much worse. So, the conditioning information is definitely important here.
Maybe adding to this, as Heiner said, it's very restrictive. It's set up this way to keep this interpretable. What we've tested, of course, is can our strategy be explained by factor models? Yeah? So some firm characteristics which go in there as well. We have also tested if our strategy actually adds additional value to a machine learning approach. So this Gu-Kelly-Zhu model, of course, the alpha is much lower, but still it is significant. So there is some orthogonal component to this unrestricted version, so to speak, from a plain vanilla machine learning approach in predicting returns.
And maybe going back to this return only model, what we've done there is kind of a very crude approximation, right? It's essentially a way to kind of show that what we are proposing is working better. What you could also do, obviously, is to have, to introduce more information into, the returns, the look back returns themselves. We're using them plain. And if you're just using plain returns, you obviously have a heavy factor structure in these realized returns over the formation period, right? The market factor is going to do a lot of driving of these returns. So I guess you could do things like residualize these past realized returns with respect to some type of factor model or just the market to make it more expressive to actual, firm-specific information that we in our setup are capturing somewhat elegantly with the firm characteristics, right?
Yeah, and maybe adding to this, we wanted to keep it interpretable. So there is definitely a lot of things you can do to make it, I don't know if you could make it better, but we had to trade off into interpretability and performance in a way. So for academia, of course, we'd like to understand what's going on there. And whenever you use machine learning, this black box model, it's hard or difficult to understand what's actually going on. And reducing by using firm characteristics and reducing them into one single number is something you can track and which you can interpret in a way.
And did you try, using something different than machine learning? A linear model or anything? So because I'm sure that you were looking, I know that this is not the way how it should be done, but you definitely looked on what firm characteristics are important, and what are the features that are actually important. And I believe that the days that are probably imparting the performance of the model are earnings news and stuff like that for probably each of the company. So instead of machine learning, maybe it's possible to, do that linearly if you know, what are the features that you would like to use and which days you would like to, change the weighting. But of course, it doesn't have the beauty of the machine learning that you are already, building the model from the, future, knowing what should be changed in the past. Of course, this is not the correct, but I'm interested to know what are actually the features that are probably the most important for the model itself. So earnings is definitely the one. Yeah, earning dates. And what do you think is the other?
So I guess we have two kind of sets of inputs here, right? So if you look at the realized returns, earnings are super important and are just generally days where, the stock has had a very large return, right? These are just very important.
Large movements, exactly.
Exactly.
So it doesn't have to be connected to any returns or to any news. Sorry, or so it can be just that the stock has a movement for some reason. Yeah.
That was my second question.
So it mostly is, right? And I guess one thing that you could do to make the model more targeted in its kind of selection of names that it chooses to react to would be to give it information about that. Right? So say you have your look-back period returns, you could essentially give the model information about, hey, this is an earnings day. These are the days surrounding the earnings day. This is a macroeconomic news announcement day, yada, 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 the whole stuff, which is something that we have thought about. It would complicate the model. I'm fairly certain that it would add to the general setup. I think it would be worthwhile. We've decided not to go that route, as Timo said, for simplicity's sake. But I fully agree. That's, that would be super interesting to really understand, okay, which of these days are important and importantly, why, I guess.
I'm just asking from the, perspective of practitioner. So that's the reason. Yeah, I understand. Okay, Michael, you have a question.
So I only have one left because you took my middle one.
Sorry. Sorry for that.
So your weighting patterns and the subsequent return continuation are consistent with underreaction, but the measures used to identify the underreaction are constructed from the same returns and estimated weights that generate the strategy. So can you provide evidence based on an independent measure of news, investor beliefs, or information processing frictions that distinguish the underreaction from the risk compensation, persistent fundamentals, later news arrival, or trading frictions?
From the paper, no, we can't. We've decided to keep it within the framework in a way to maybe position the framework as a way to say, hey, you can also use this to understand what trend following or momentum type profits are actually exposing you to, right? And within the model framework, it suggests that it is underperformance. Now, I fully agree, right? It would be better to have some type of external information to be used here. That would give it more credibility. What we do is rule out some of the other explanations in a way, right? So underreaction versus overreaction, we do that from within the model context, but we do have some results on, this very likely not being time varying or time varying compensation for risk. If you believe the story of the paper that we base all of this on, right? Obviously, but I think this is where we are trying to add to the debate. And as I said, we try to kind of keep it within this model framework to try and say, okay, hey, this is also useful to understand what is kind of going on in the market. Because on average, it's underreaction to news, but it's not always the case, right? There are undecided cases. There are some where it's overreaction, but of course, it's, if there is measurement error, it's all flawed, essentially. Yeah.
Yeah, you bring up a good point with that. I was working on an option strategy that uses implied momentum as the base story. And as I tried to improve the paper that I was replicating using options metrics, it turns out it kind of invalidated the story. So the paper I was replicating was, the results were right, but the story was inconsistent when I pushed on it. And I don't know, maybe that's true or possible with yours as well.
It can be, yes. I would say it isn't, but maybe I'm biased here in my assessment.
Okay, I have a question. Do you plan to trade the model?
I've actually talked to a hedge fund that is using a variation of the model in their own operations. So it is kind of being traded, not by myself, but yes.
I'm just asking, out of curiosity, because maybe in 5 years, and we will have another discussion about the other of your paper. We can revisit this one. I mean, whether there is some change in performance after, we have this video out and your paper already won the award. So we will see in the 5 years. So, this is the question. So
I guess that would be an interesting field study. Yeah.
Get a hedge fund to finance extensions to your theory, and then they can own the IP and make money.
True. Yeah. But yeah, it's certainly very interesting to try and actually translate that with all of the baggage that comes from going to kind of the academic world, which does have a few things to make it simpler. Let's put it that way.
Yeah. At the end, it will be needed to, pick the investment universe for the firms that are investable. However, the spread between the performance of your model and the momentum is, broad enough. So, if there are funds that are trading momentum and they can improve on that, so there is, definitely the way how to improve, the momentum strategies by, weighting the returns differently. And so there is definitely a way to, gain the alpha. So because, the momentum is tried to be traded in liquid investment universe. So there is definitely a way. Okay.
I apologize because I don't remember the paper that well, but one of the really interesting things you presented in the slides earlier was the gap between traditional momentum and your strategy, whereas the traditional momentum really wasn't holding its weight against a passive index, and you did, right? And the natural question I would have would be, are the features of that outperformance can it possibly work against you in a way you didn't calculate? So for instance, if there's a lot of turnover or the bid-offered spread of the stocks you choose to overweight are so wide that the transaction costs kind of take away from that outperformance, and you end up with a realized performance that really isn't quite as good as your paper was able to calculate under your back test.
Yeah, I think that's certainly a concern. Right. We do have in the paper kind of some results that are not using this value weighted approach. So this is an indirect answer to your question. But so for most results, we're looking at this value weighting, which tries to combat that in a way, but not really. Right. So it would be better to kind of make this more explicit. But what we do have in the paper is kind of a signal-weighted version of the characteristic momentum, right? Which is essentially just saying, okay, you take your expected returns and you divide them at each point in time by the sum of the absolute expected returns. So that not only gives you, no bound when it comes to a proxy for investability, which would be the value weights, the market cap, but it also gives the model to have kind of like a market timing component to it, right? Because you are not always perfectly long short, market neutral, but you do have a way to kind of wiggle around that. And it works much better, which essentially tells you, if you part from these constraints of value weighting, you will see better performance, right? So it does load on some of the names that are probably hard to invest in. But I'm pretty sure that you could, apply some of this to more liquid names. If I recall correctly, but I might be wrong here, I think the international data set is mostly geared towards bigger international names, which are probably still small compared to much of the US, but it holds up very well there as well. So maybe there's something to it. We also show in the paper that there's like a time series momentum strategy that you can back out of this, which also works. So I'm hopeful, confident, whatever the word is that you want to use to describe that, that it has merit in an actually investable universe, right? Which again is one of the gaps that you see between a lot of academic research and actual investable strategies.
Yeah, maybe adding to this, sorry. Yes, sorry. No, I just wanted to add that we have in the paper an estimate of transaction costs as well. The performance, of course, degrades. It's an estimate. So it's not been implemented, so we don't know what the actual transaction costs are. But following academic research, we've got an estimate in there, and the results still hold true. And the second thing we tested, which is not in the paper, but at some point we started to look at how does the strategy performance change if we exclude X% of the smallest stocks. And the performance degrades, but it still is better than standard momentum. So if people were to trade standard momentum, they would be better off with our strategy in a way.
I wouldn't be as worried about capacity constraints like you're talking about if you're using large stocks. I mean, unless the investor is CalPERS or something. I'd be more concerned about the volatility, which probably is always coincident with your signal. Right. And so even a large stock, if there's a high volatility, then your chance of getting a good price is more random. Right. And possibly on the negative side of fat tail. That's kind of what I would think. So maybe your strategy will still work well, but adjusted for bad fills, you might be degraded. And that degradation may start to match standard momentum strategies more directly, because maybe the stocks you're picking that the standard momentum strategy isn't are exactly the stocks that are hard to fill, right? So I was trading a similar long short strategy a few years ago, and the stocks that we wanted to short turned out to be so hard to borrow that the strategy didn't work that well at a sample, because we just couldn't get the stuff that performed well, with our counterparty bank. So it was great on paper. And so that's what I would, maybe be more concerned about if you wanted to implement it in practice.
Yeah. I mean, what Timo has said, essentially, I think it goes up to excluding 80% of the smallest names. So this is probably S&P 500 that you're left with, from the universe that we start with. You still see that the, Sharp is actually fairly good at 1.2, 1.3-ish over the full sample period, right? So I guess for these names, that is probably less of an issue, especially the borrowing, I hope. But of course, you can never rule this out. And as Timo has said in the presentation, you do find that there's a slowdown in the performance also for CMM recently, right, over the past 2 decades, which a lot of the signals that you can generate from publicly available characteristics simply share, right?
Yeah, that's true. It's true.
One of the elements of your strategy is that you trade high volatility on days that are normally volatile, whether you're correct or wrong, right? So an earnings announcement, right or wrong, you're going to get extreme volatility. So you're automatically in danger of getting a bad fill, not just if you're right and you might make money, but an even worse fill if you're wrong and you'll lose even more money than if you traded in calm times. Any volatility strategy is going to be subject to something like that, unless you're going against the market.
Just always hope that you have good execution.
Yeah, I mean, at the end, you need to have a good execution. So, okay, I do not have another questions, Michael.
And not off the top of my head, no. It seems like a great thing for you guys to pursue, though. I know a lot of hedge funds like to invest in strategies like this that are academic. I've done a few consulting contracts where I took academic papers and then I rigorously test them in the kind of circumstances that the hedge fund would actually use them in. That's kind of where my questions come from. The kinds of things they ask about. Concentration risk, they use their own market impact and transaction cost models based on their own transaction database, right? So their transaction results might be different from anyone else's because how they execute is different, right? And they just base it off their own. Doesn't mean your strategy is good or bad. It just means it might be good or bad for them,
Sure.
So that's a great way to make money.
That's good.
Okay, so we wish you luck, especially that you are out of academia. But we hope that, other papers will be maybe published in the future and that you will join the Quantpedia Awards once again.
Yes.
So thank you very much. Thank you for joining the video. Thank you for joining the interview. Thank you, Michael, for joining the interview too, with your questions. It's always a pleasure to have you here. Thanks.
Always a pleasure to be here. Yeah.
Thank you very much.
Thanks.
And
Thank you very much.
I hope that we'll meet once again in the next maybe video. Thanks.
Sounds good.
Thank you.
Absolutely. Thank you very much.